Alrighty. All right, guys, good morning. Give me a yes if you hear me real quick. Perfect. All right, good morning. Welcome to the Hurley Investments Trade Findings and Adjustments of April 27th, 2023. What a morning. Check this out. Big bounce off of 4,050, up 50, over 50 points on our S&P. Why is that? Look at this guy. Our Meta, you'd think it's down here, but no, this is today. Way up here at this pivot point up at 238, 239, 240. Sending us into overbought territory. Last time that happened, well, not last time, because we've had a couple other times as we've had this amazing bull run on our Meta stock. But last biggest time after their earnings, which would have been this guy back in February, and they stayed overbought for like a week and a half. Came back down 190 all the way to 170. That's not a small amount, but held there. And we've had, we can get my pen out. I don't know why I have brown here. Weird color to use. One higher high. Excuse me, higher low. Another higher low. Higher low. Another higher low. Came down just a bit pre-earnings, just below 210. And up to there. Where is the next higher low? I hope you guys understand what I'm saying by saying higher low. Every bull run has a point where it pulls back, but each of those pullbacks, the lows of which are higher each time. So you get higher highs and higher lows. Never perfectly up, never goes perfectly down. It's very jagged. And you get a higher high and a higher low if you're in a bullish run. And actually, if I'm being honest, after this higher low, we dipped back below that yesterday or 2 days ago. So that's technically not a higher low, just to be precise. But you guys get the idea. Starting to try and break this trend line, you can kind of imagine here. Starting here back in December and just touching all these higher lows up till about here, and we're kind of breaking that until pre-earnings, until we had our earnings, and kind of back up, not kind of, very back up. What is the next stopping point for Meta? As I mentioned, if we're going to get overbought here, similar to last earnings, we could kind of stay in this portion and come back down to 225 or even 220, as that was the last real trading high. I can maybe zoom in here so you guys can see a little better. So this was 220, pretty close. 4 days here where it couldn't really, tried to and couldn't really stay over that. We have this pivot point right at 225. So I would like to think, since they had such an amazing earnings, we would just continue up. But if I'm looking at past history, we might get something like this, where it kind of has a reaction, pulls back a bit, and then continues on up. Because we can get back up to what, 300, 350 on Meta. So let's come back to this. We'll talk a little bit more about what we are thinking for Meta, but just to show you guys, we're up 243, 1.86. Market is up, if I have it on open on my phone here, 1.2, 1.22. So nice to be beating the market. As last week we haven't necessarily done that, with some of our stocks starting to come down in the market more flat up until the last couple days here. But where's Meta? Of the 243,000, which some of that's Apple, some of it's, I mean, most everything is up today, so you take your pick, but here's Meta. Took off our Meta puts and got about 181 for them, somewhere close by. That's not our closing price, that's just the current price it's showing them, which would have been fairly close. But 184,000, up almost 14% in one position in one morning. So these are the types of days, types of things you get to see in color trading, which is the technical name of what we do, using puts and sometimes calls, to short calls, covered calls rather, to protect our stock ownership, like insurance. Ensure our stock ownership through earnings, through risk, through rate hikes, through periods where individual stocks just absolutely get hammered, through Meta that was at one point in time trading at above 300. I think it was around 350. But we color trade through all these periods to have these types of days. 375, 380. Here we are. Yeah. 384 looks like was probably the high. But if we can protect on these ridiculous, huge down periods, 384 dropping down to 250, down to 175, 160, all the way down to below 100. And it was down to like 89. Well, almost you'd be pretty close to 3/4 of the value of your stock gone. And all we did was cashed in those protections at certain points. We did add shares somewhere and then had to keep protecting. Then we started to add shares again around what, 117, 125, maybe a little sooner. Actually, it was, yeah, it was pretty close around there if I'm remembering right. Doesn't really matter specifically, but we're cashing in that protection, adding shares at lower prices, and reaping the amazing rewards as it comes back up. And we're hitting our break-even levels much lower than 385, 384. So I want to say it was pretty close to, I think our break-even might have been more close to around here, 160, 170. But by the time we get back up to 380, you know, we're at we've more than doubled our position, and we're at 100% return rather than just getting back to to break even. And that's why what we do matters and is better than just sitting in the market. We can dollar cost average in a meaningful way, in a more meaningful way than just throwing more money at it or asking for our clients to put more money in. We can buy the dip all organically through how we manage the money. All right, so last time we went over Bank of America, talked about 38s being a support level. They did great on their earnings, and of course, like typical Bank of America fashion, just are not getting any of the benefit for it. But around 28, they are bouncing today. A little lower than I thought it would. Thought they would hold 30, but with the banking sector the way it is, even though the big banks are totally fine, having no issues, the market is worried about the SVB collapse, the First Republic Bank down like 90%. So, of course, that means the banks that are profitable and do great get to lose money as well, which makes perfect sense, of course. Totally reasonable. And I hope you can hear the sarcasm dripping from my voice. Just reading through Bank of America, protect profits, what we were talking about. I thought it might hold 30. Didn't quite. but the next stopping point, of course, was 28, which I mentioned. We'll see if it can hold on to that over the next few days. And just to follow up there, Bank of America, we still have 28 puts here, which they aren't helping us, but they were sort of helping. Really not enough left in them. There's only 3 cents of premium, so they're all but worthless, but we had it on there just in case it continued to go down, which it could. But we're going to expire here on Friday, so probably be looking at taking those off because we're probably not going to get a better price as it's come down than the 3 cents that are still there with it close to the strike price on 2 days, or excuse me, a day before expiration. It's about as good as it gets for that scenario. That's Bank of America. We went over Baidu at length, talked about where we put protection on through this choppy season, took protections off, and made some net positive good choices there. Let's see, this would have been the 20th. So the 20th, last time we talked was right here on the 200-day. I had talked about leaving protection off. We had booked a profit on, they must have been 140, 131s. I'm trying to remember. Well, maybe I wrote it down. Let's see. 152.50 puts on 327, 417, booked a big profit 152. So 317, 152.50s kind of went up, came down, had them on till, excuse me, 327 to 417. So 327 right here. The only way you would have done better is by waiting one more day on those puts and done it up at closer to 160 on March 28th rather than on 27th on 152.50. But you can't always get what you want, and that is a pretty good point, if you ask me, to book on April 17th. Bounced off that 200-day, was kind of holding that pivot point. Said, okay, this looks like a good point to take off protection. Couple days it was holding it, then came back down to test the 200-day on April 20th. And I said, I think we're going to see it hold that, and it's overbought. Excuse me, oversold. Actually, it wouldn't have been oversold on that day, so I take that back. But it's holding that pivot, that moving average, and last week I said we'll look at it end of day or Friday and see if it's not holding it, we'll just protect it. But my desire was to leave it alone to see it bounce off that support level. Then later on Thursday, the 20th, I said, you know what? It is not holding that 200-day moving average, and it's so small you can't really see it, but it held it by the end of the day. But that last hour was kind of crazy, and it was falling below. On the low was 126. So we got protection on. It just seemed prudent then at that point, even though I was willing to let it go earlier that day. Kevin talked a little bit about this on Monday in his webinar about how the market is just kind of a living, breathing, organic thing that can change uh, in ways you don't expect rather quickly. But I can tell you, I'm pretty glad that we got on that protection, which was 125s. That was the closest strike price because they're in $5 increments. But I got on those 125s and they're looking good as of today. Sitting in the money as Baidu trades down at 118. Obviously, we're losing a bit as it's going up just a little bit today, but overall, we're going to be fairly profitable. I think we bought them for like $7, so they're up about $3 or so. I'd like to see it hold this point. We've got earnings coming up. Got a 120-ish support level, which it's not quite holding that, but somewhat close. That would be kind of the next stopping point that I would think would be there. The outside of that, it's down here at 110, 111, where this pivot point is. And at that point, we probably would look at cashing those puts in and running 110s through earnings later in May. Supposing that it does exactly what I described. Starts heading up, who knows, we might just keep them on and have some good protection there. All right, so that's Baidu. We have done some good moves as far as protecting on Baidu, and I'm really happy with how that's gone. Because it hasn't always made sense. In fact, this whole downward trend of the last month hasn't necessarily made a whole lot of sense news-wise, just kind of went that way. So nice to be able to have those 152.50s with a great profit, and now we've got the two 125s that are helping us out right now. So we talked about when to protect, when to take protection off. If you missed that one last week, go ahead and go to myhurleyinvestment.com. It's this link down here. There, My Hurley Investment singular. Just go to the April 20th, and I go through in detail what we did through the last several months with Baidu, as it's kind of been jagged sideways movement, and how we've managed to be net positive there on puts, on our protection, and why we justified taking puts off and putting them on. Okay. Questions so far? Anything you guys want me to touch on, explain? Can be anything, doesn't matter to me. I also mention if you haven't seen Kevin's last webinar, I would check out least the first 20, 25 minutes of that one on Monday, from Monday, which would have been, what was Monday? The 24th. Some good stuff talking about averages and average returns that everybody seems to love to talk about in the stock market, and that are just not realistic projections to use or realistic numbers. And many premium financed life insurance policies, many financial plans have gotten completely destroyed because people keep assuming that the market is supposed to do 8 or 10% every year. Jeff asked if the website has the notes that we make in it. Yes. In fact, why don't we just go there? I'll show you exactly what it looks like, Jeff. So it pops up like this. This would have been my last trade findings and adjustments on the 20th. This was Monday's market commentary from Kevin. But you go in there, click on the date, you have your YouTube video. In fact, you can look us up on YouTube as well. We have all this here, but this has the notes. You have everything that he goes through. Talked about a article where they were saying how much your money would be worth 5 years and 10 years if you had invested $1,000 in the stock market. They said, for 10 years, your $1,000 would be over 3,000. And he just goes through the numbers and shows you how that's not true. It would be roughly 2,000-ish because they were using average returns, which would have been what, 8% is your average market return. If you go back to all they're doing to get an average return, why you always hear, oh, the market, averages 8%, or you can expect 8% a year annualized or whatever from our stock market, is because they go back to what, post-war time, and take the number there and our current number in the S&P and divide it by all those years, and you get that average return. And it makes you think, oh, well, the market's supposed to give me 8% every year. And of course it doesn't. It varies so greatly, up at 20% one year and down 10% the other year, down slightly another year, up just a little bit another year, down 50% one year, or more recently 28, 30%, and at one point and during COVID, and then is up 16% by the end of that year. It's just, there's so much variability in our stock market that trying to use that average return to estimate returns into the future is just very, very stupid, because it's such a long time to have used that number, a long period of time over which we're estimating, we're annualizing the overall return of the stock market to put in expectations for the future. It just doesn't make any sense. It's silly. It sets people up for failure. So he goes through more of that. I would recommend checking that out. I'll let him explain it a little better than I just did in theory, and he'll show you the exact numbers. And it's why we don't do the indexing thing. And it's why we don't do financial plans, which by several other guys, several other financial planners have told me, yeah, well, we do the financial plan. If it doesn't work, doesn't go the way we thought, it's like a flight plan and you adjust your flight coordinates and it's like, uh, that's assuming that where you're getting is where the stock market, where you would like to get is where the stock market is going to be in 10, 20, 30 years, when it just doesn't always do that in the time frame that you want. So, absolute nonsense. We aren't going to lie to you or tell you just wait. You gotta just let the market take care of its average return. It just doesn't always work like that the way you want it to, and in the time frame your retirement funds need it to. And don't get me started on bond funds. Absolute waste of time, absolute waste of money. Uh, so many I've seen just lose more money, cost more money in fees than they do in the um, in the yield return that you get. So that's my soapbox. I wanted to go over what we're looking to do for Meta now, just to give you some ideas for a trade. Jeff asked, do you ever use relative strength in stock selection? You mean the RSI, relative strength index? Is that what you're talking about? No, we don't use relative strength. Um, we go through, we do the Warren Buffett thing of finding the most fundamentally sound companies, the companies that are typically the strongest in the industry, in any industry, typically the companies that have a moat, as Warren Buffett talks about, of um, something like Disney, where they have so much good content and it's so um, highly regarded, it's hard to be knocking them off their perch. They've got a good moat. So comparing stocks to the index or other stocks, yes. I mean, obviously, when we go through those fundamentals, part of the decision making is comparing them to like companies, and which is how we arrive at who is the strongest. Typically, it's the one with the highest market cap, but not always. Um, if you go back, speaking of the website, go back to, I think it was January 22. I think it was like January 6, 2022. You can go all the way back there. Let me see. You might have to click through for a while, but it's like one of the first ones in January 2022. Kevin goes over exactly what we look at when we're looking at new stocks and positions to put money to work in. We don't do it very often because we stick with the companies that we buy for long periods of time and typically only sell them when they're at a good, a really nice profit and they're fully valued. That way we can take a profit and roll into something else with them with a better growth outlook. So Jeff asked, so basically look for strongest stocks and strongest sectors. Yeah, I mean that's part of it. That's a big part of it. But they have to be fundamentally sound, and that isn't always the case with. I mean, not just fundamentally sound, but they have to be at a discount. So take, for example, the difference between Nike and Under Armour. Nike, bigger company, um, has a better moat. It's just the brand is stronger um, with regard to their moat. They're the first, they're the biggest, the best. They're not going to be kicked off their perch, so to speak. But they're trading at a premium. They're expensive relative to what they make. Let me see if I can get. I'm running out of power, so I might have to wrap it up fairly quick. But let's just look at Nike. PE's 35. Ford PE's 30. And this will be interesting because this might have changed quite a bit. I'm comparing it to Under Armour PE. Ford PE's 14. Price to earnings ratio. So it's in comparison earnings wise, what these companies make. Under Armour is at a lower price compared to their earnings than Nike is. So there's more value there. They're at a bigger discount. There's theoretically more upside. They've been beaten up time and time again for really no reason. So that and we could go into more detail, but um, those are some of the things we look at, and some doesn't necessarily have to be the greatest and biggest because that might not always be the best deal. But Under Armour, which is why we'd go with something like Under Armour versus Nike in that case. But go check out that, see if you can find that webinar that we recorded. You can even look at on YouTube, might be easier to find it than our website. Just so let's see. This gives me all the 2022 webinars. So maybe just search for 2022 and just keep going back. Oh, here. So that's 21. You go back the other way. So I think it was this one right here. Welcome back, 2022. This shows how exactly we work our numbers, where we do our research. I mean, this gives us everything. Shows what screening we use. Look at charts. And then this is our 14-point checklist. Well, we want to check off at least 10 or 11 positives out of the 14 points. to make sure that we've got our ducks in a row when we're looking at a company. So he goes through all those things, and it's fairly straightforward. So there you go, Jeff. Check out that one. And I'll actually even just copy and link that into this one. And so when we get it posted, you can just click on that link and it'll go straight to this day, I think. Should, theoretically. All right. No problem, Jeff. Absolutely. Glad we could help. Meta, just be looking at buying Leap long. I'll say Leap bull call. And part of the thinking on that one, and I hope I don't get closed down here. I'm really sorry if I do. I'm gonna try and see if I can't get my power cord. Meta here, something like a 240, 285, 240 short, excuse me, long call with 285 or 290 short. This way, if we get a pullback from being overbought. Oh my goodness, I'm trying to do this quick. Have something protecting us a bit. So that is something I would be looking at as far as a trade. And you just have to work your numbers. You could just do a 250 leap long call, just going up a bit above the 240, so it's not too expensive. But we're still in sort of an economic uncertainty period, so having a short call there might make a lot of sense. Hence the 240, 285 or 240, 290 long to long short, giving us plenty of upside and some protection if it goes the other way, where we'll have a short call to take off and dollar cost average our long call with the profits of a short call should it go down. Most of the time we'd probably just be leaving it there and just letting that short call lose value over time and seeing it come back up, but we can of course talk more about that next time. So go check that idea out and I'll let you know. Well, maybe I'll have Kevin let you know what we chose to do on Monday. That way you can, there's plenty of time to look at it, get into an opportunity like this. Meta just did incredibly well. So huge upside and we want to take advantage of it, obviously. So that does it for me, guys. I'm pretty sure I'm going to get my computer shut down here any minute now, so I'll leave it at that. But thanks for joining me, and look forward to Kevin's webinar Monday. Please join that as well if you can, and we'll see you next time. Have a good weekend. Take care.